This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. There is one last thing which does tend to upset a few people, and I always think is a little bit stupid from an exam point of view. And it's something we call ticks. Now, although obviously I'm going to explain what a tick is, ticks are used in real life. In practice, ticks are important. In exam questions, there has never ever been a question where you've actually needed to use ticks at all. And I'll start again when I've explained them. So I'm going to explain. It'd be awful if a tick was mentioned and you'd no idea what it was. But as I say, you've never actually needed to use them. But what it is this. Futures prices, like exchange rates, are quoted to 4 decimal places. So in that last example, for instance, the futures price started at, what was it, 1.4840. And of course, we've said enough times, from day to day the futures price can change. You know, the next day it might have moved to 1.4850. And from a purely practical point of view, if you were to sort of ask the dealer, oh, how much has the price changed by? It's going to be a bit cumbersome. If he says, oh, today the price has gone up by 0.0010. Tomorrow, oh, it's gone down by 0.0008, and so on. And so the way dealers talk about it, they refer to the movement in ticks. Now tell me, what's the smallest movement that could possibly be in a futures price? Surely the smallest movement, since we go up to 4 decimal places, the smallest change that could be is 0.0001. Well, instead of keep having to say 0000 all over the place, the dealers refer to a 0.0001 movement as being 1 tick. And so, that one I wrote down. If the price moved by 0.0010, if you ran the dealer and said, how much has the price changed by? Instead of telling you it's gone up by 0.0010, he simply says it's gone up by 10 ticks. If the next day it fell by 0.0008, he'd tell you it had fallen by 8 ticks. So that's all. I mean, it's just terminology, but a tick movement is a change of 0.0001. There's one other way the dealer can use that, though. Is when they come to work out the profit. Look back at the example we just did for a moment. How did we work out the profit? We said there were 5 contracts, each one of 62,500, and on every pound we here made a profit of the difference here. What was the difference? The price went from 1.4799 to 1.4840. So the difference, 1.4840 minus 1.4799, the movement was 0.0041. Well, as I've told you, the dealer is not going to tell you, oh, you've made a profit of 0.0041 on every pound. He'll tell you there's a profit of 41 ticks. But there's one extra way he can save himself a bit of time. Because just suppose I told you that we had one contract. The contract size, same question, 62,500. And suppose I told you that there'd been the difference between the buy and sell, there was a profit of 0.0001, which is 1 tick. Well, how much would the profit be in total? Surely the profit we'd end up with is one contract, 62,500. If the change is 0.0001, what does that come to? It comes to 625, and remember it's in dollars, because always we were trading on the dollar value of a pound. So it means now that whatever happens, the profit will be $6.25 for each contract for each tick change. Well, for the last time, look back at the example we just did. In example 11, how many contracts did we have? We had 5. Five contracts. When we looked at the profit, the difference between the sell and the buy price, the difference was 0.0041 or 41 ticks. And we've just calculated that the profit per tick per contract is $6.25. And so what's the total profit? $6.25 per tick contract, 41 ticks change, 5 contracts. Which is exactly what we got before, 1281.25. And so it really makes no difference at all. Quite honestly, in every exam question there's ever been, when I've done it, sorry, this is a terrible mess now, but I've shown the workings the way I have done all along, and that would get me full marks. In practice, because the dealer is obviously doing this every day, we can argue about this, but the dealer, in a sense, saves a bit of time. He says the profit or loss, for that matter, if the price had gone down, but it's $6.25 for every tick, for every contract. So as I've just done there, he just multiplies by the number of contracts and the number of ticks, the difference in ticks between the buy price and the sell price. Okay, one more thing I better mention about numbers. In every example I've done, I've quoted a futures price as one figure. Again, I'll use the one from example 11, but I'm not going to go back because there's no more work to do on it. But we had a futures price of 1.4840. And in every exam question there has ever been, with one exception, every exam question there's only been one futures price on any one day, obviously. And the examples have always been like mine. However, the last time the current examiner asked it, he actually gave 2 prices. He gave you, let's say there were September futures, instead of just giving you the one price of 1.4840, he gave you 2. He gave you what's called an open price, maybe it was 1.4840, and a settlement price. Let's say 1.4838. 38. Now, as I say, the current examiner, the Bob Ryan, the guy who until now has written the exams, he was the first person to ask a question where he gave two prices for the future, the open and the settlement, and there were actually a lot of complaints, but he defended himself. If that happens again, I say it's never happened before. Before, you've only had one price. If it ever happens again, it's no problem. It doesn't affect anything we've done except the open price. That's the price if you're buying the future. Settlement price is the price if you're selling it. So he's saying on any one day there'll be two prices. So if today I ring up the dealer and say buy futures, fine. The cost will be 1.4840. On the other hand, if I ring today and say sell futures, the relevant price will be 1.4838. So that's all. It doesn't change any of the workings. You know, the profit or loss on the deal is the difference between the price at which you sold them and the price at which you bought them. It's just if on the 2 days, on each of the 2 days, if there are two prices. If you're buying today, it's 1.4840, it's the open price. If you're selling today, it would be the settlement price, 1.4838. All right, that's everything for the numbers, but very, very last of all, just one little bit for the written, which is at the bottom, if you want to use the space, at the bottom of page 108. Because we've now looked, in terms of the numbers learning, at three ways of dealing with the risk. We looked at forward contracts. We looked at money market hedging. And without repeating everything I said about those two, obviously I'm not going to go back through it all, but if you remember, I said the end result was effectively the same, that with both of those, it fixed the amount completely, you had a fixed amount on the date of the transaction. The downside was, though, that there was no flexibility. It had to be a fixed amount on a fixed date. And that was the problem. The amount, perhaps less of a problem. Clearly, if you're buying goods, you know how much you're going to pay. If you're selling goods, you know how much you've charged them. But the real problem was the fixed date. You know, if you've gone for a forward contract 3 months forward, you had to convert at that rate in 3 months' time. And I said at the time, the problem is, what happens if you get the money a bit early or a bit late? Especially if you get it late. You know, you're committed to convert the money on the fixed date. Well, we've now looked at using futures. And of course, futures, there's obviously more work involved. And also, it's never going to be a perfect hedge. So the amount is not exactly fixed. Given you're dealing in large amounts, as you have to because of contract size, the difference remaining is unlikely to be substantial, but it's not going to fix the amount exactly. But the huge beauty of futures is that they're flexible. Because remember, although you have to complete your futures deal, you know, if you've bought futures, you have to sell them, and vice versa. But you can stop the deal on any day you like. You know, our example earlier, it was the 12th of September. But suppose for some reason we had to pay earlier. We had to pay on the 1st of September. No problem. Convert the transaction on 1st of September. Finish your futures deal on 1st of September. You're not stuck to any one fixed date. The only limit on you is that if you've gone for September futures, you have to finish the deal by the end of September. So if you thought there was any chance of the transaction date being later, you'd have gone for a later future. But apart from that, you're not limited to these fixed dates. That's the beauty of futures, that they're flexible on the timing. You can finish the deal on any date. Up to, of course, I'm not going to write down, but up to the end of the future. You know, the September futures, you've got to finish by 30th September, but you're not limited to one particular date. And that's what makes them so attractive. Just one more downside, though, is, of course, because there's fixed size contracts and they're fairly substantial amounts, 62,500. Of course, it's only suitable for large amounts. That if it was just $10,000, to start using futures, I think you'd agree would be a bit silly when you'd have to deal in 62,500 as a minimum, which then would turn it into more pure gambling. And it's not the financial manager's job to gamble. I've already told you, speculators make money out of futures. You know, if you think the price is going to go up, buy futures just like people buy shares to try and make a profit. But that's not the job of the financial manager. His job isn't to try and make profits out of futures for the sake of it. His job is to use the futures, gamble, to cancel the risk there is in the transaction. However, I'll leave futures there. That's finally the end of chapter 18. I'll do another lecture on chapter 19. We'll look at the other bit of numbers, which is using foreign currency options.